Hi guys. Today we will analyze Adobe stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. Adobe is a bad performer in the overall market. The short-term trend is negative, the long-term trend is negative. There should be more interesting stocks out there. Support level is around $443. The next support levels are around $425 and $385. Resistance level is around $473. The next resistance levels are around $500 and $520. In the last month the stock has been trading between $417 and $522 range, which is wide. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 3.5 million. This is a good sign as it is always nice to have a liquid stock. The stock is currently trading in the lower part of its 52-week range, which is not a good signal. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 22% per year, for last 5 years. We see that the average profit margin of the stock has been around 30% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 137% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Adobe Company: bad, average, and good. First scenario. Adobe will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 12%. Future profit margin would be low, 24%. Future free cash flow to net income rate would be low, 100%. In this case, the fair value of the stock today would be $209. Second scenario. Adobe will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 14%. Future profit margin would be average, 27%. Future free cash flow to net income rate would be average, 110%. In this case, the fair value of the stock today would be $274. Third scenario. Adobe will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 16%. Future profit margin would be high, 30%. Future free cash flow to net income rate would be high, 120%. In this case, the fair value of the stock today would be $354. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 10.01. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Adobe, analysts forecast growth rate around 12% per year in next 5 years, and future P/E around 32. Again, I will use 3 different scenarios for Adobe Company: bad, average, and good. First scenario. Adobe will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 12%. Future P/E would be low, 16. In this case, the fair value of the stock today would be $160. Second scenario. Adobe will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 14%. Future PE would be average, 20. In this case, the fair value of the stock today would be $235. Third scenario. Adobe will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 16%. Future PE would be high, 24. In this case, the fair value of the stock today would be $329. As you can see, today the stock is overvalued, $452, even if we expect the company's high performance in future. The fundamentals are good. Adobe shows good growth, but the stock is currently too expensive. I would be happy to buy the stock when the stock drops below $360, pre-pandemic level. Company's strengths. Adobe provides software for creative professionals, consumers and enterprises. Its products are organized into 3 segments. The flagship digital media segment includes the Creative Cloud and Document Cloud business, with such applications as Acrobat, Photoshop, and Flash Player. The digital experience segment includes the legacy Omniture web analytics businesses. The third segment is the small publishing and advertising segment. Adobe has positioned itself at the center of the exploding market for digital video content and advertising creation and management. It consistently shows strong revenue growth, high margins, and earnings momentum. Adobe has a unique collection of software assets centered on its Creative Cloud tools, which enable both professional and amateur users to create and manage digital content. In addition, it is extending Creative Cloud cross-functionality into the emerging areas of 3D and augmented reality. The company's adoption of a cloud SaaS model has enabled it to execute a faster product refresh cycle and rapidly introduce new and adjacent product offerings, raising the value of its products for existing customers. Adobe's return on assets of 18% and return on equity of 32% are amongst the best returns of the industry. The company's profit margin of 30% is amongst the best returns of the industry. In the coming 5 years, the revenue will grow by 12% yearly. Adobe is expected to show quite a strong growth in earnings per share. In the coming 5 years, the EPS will grow by 15% yearly. Risks. Adobe's technology software market is intensely competitive. The company must continually update older products and launch new products for which customer demand is uncertain. It is critical for Adobe to defend its intellectual property from other claimants and potential infringers. In addition, security is always a concern with software, and the company's reputation could be damaged by software-enabled security breaches. Because Adobe is a successful growth company, its shares tend to trade at relatively high multiples of revenue, earnings and cash flow. Expectations are high, and if the company's financial results fall short, investors could experience a significant and abrupt decline in market value. Other risks include unexpected pullbacks in software investment spending, adverse foreign exchange movements, and the impact of the coronavirus on software spending. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.